What's exciting? Jackson Hole. Nick, what the hell is Jackson Hole?
Well, that's where all of these central bankers come and meet and start to make forecasts about the future. And of course, forecasting relies on data. And as we had, we have to say it. We had this week wonderful data. We had the data which basically said that the data that everybody, sits in front of their screen once a month to look at what's going on with the employment in the economy. Well, it doesn't make sense because
Holy fuck, shit, it's a dinosaur. Jesus Christ, what the fuck?
Welcome, ladies and gentlemen, to yet another issue of the Grey Market Talk, which Nick, portfolio manager extraordinaire, and Thorsten Wegener, market maker, retired with grey hair, have recorded this time on Friday while the markets are still ticking. Hello, Nick.
Good day to you.
So why are we doing that on a Friday, Nick?
Because I'm going away tomorrow morning. So Sunday I won't be in front of a screen and I don't have my charts there. And, I do need my charts if I want to talk to you.
There you hear it, the luxury lifestyle of a former chief investment officer with over 80 billion assets under management. So
there's too much former about me, to be honest with you. So.
I slipped that in as well. Fantastic. So yeah, markets are still ticking, and let's dive right into it. What's exciting? Jackson Hole. Nick, what the hell is Jackson Hole?
Well, that's where all of these central bankers come and meet and start to make forecasts about the future. And of course, forecasting relies on data. And as we had, we have to say it. We had this week wonderful data. We had the data which basically said that the data that everybody, sits in front of their screen once a month to look at what's going on with the employment in the economy. Well, it doesn't make sense because they've managed to sort of reduce the employment numbers by something like 818,000 people overestimate employed over the last year. And of course, when you were sitting in front of your screen and a non-farm payroll came out and it was 250,000, you were jumping up and down saying, FOMO me up, ship it in, the economy is brilliant, sell the treasuries, they're going to put rates up and all of this stuff. And now, actually, what we know for the last 12 months, it wasn't 250,000 a month. It was something like 175,000 a month. Now, still pretty large, but, bottom line is it was nowhere near as large. But of course, what was the reaction from the market? Zero. And it was zero because, we've forgotten about that one already. So, and I think, conspiracy theory, at the end of the day, did they know? Did they not know? Do they care? Actually, I don't know, to be honest with you. But and then I have to say that you led this our green room with, well, now we know we're in a recession. I don't think so, but go and tell me why we're in a recession.
Okay, so let me splash that out. Obviously, we have differing positions where we are in this cycle, and I'm banging on for a couple of weeks now that yes, recessionary data is coming in more and more, and in the real world, people are seeing that there's recessionary data coming in. When you hear these polls from normal people in the United States, their life sucks. Yeah, they are not better off than they were 4 years ago. And when I heard this data coming in this week from the Bureau of Labor Statistics, 818,000. Oh, sorry, guys, we got it wrong by a million. Yeah, 1 million people are not working as we told you they would. And you listen to that and think, this totally reminds me of what we heard 2 years ago when this whole thing started about President Biden. Is he incapacitated? Yeah. Is he not well? Are there things not as they should be? And everybody said, he's aces. He's the coolest ever. He's as sharp as you could possibly be. You just have to be alone with him in the Oval Office and you think he's awesome. Then he has one interview or one discussion with Trump and suddenly everybody sees, no, the dude's not well. Yeah. And I think we have exactly the same situation with the economy. It's this, we see all this data coming in. They keep on telling us, nah, America's not in a recession. Everything is fine. Yeah. And then here, look at retail sales, people spending like crazy. Why do people spend like crazy? I heard a nice analogy. It was a deflationary environment in Japan for all countries. And it was, once you have this in your mindset as a consumer that you don't buy stuff in Japan because next year it's going to be cheaper, people stop buying and you get into a deflationary spiral. So what's the opposite of that? Inflation. When it really hits you hard, you think, do I buy my refrigerator this week or do I wait 3 months? No, you're going to buy it now. Oh, the credit card is maxed out. Doesn't matter, because you know next week or in 3 weeks' time, it will cost $200 more if you buy this refrigerator. I had to exchange our refrigerator in one of the kitchens in the house, and I almost fell on my ass. A normal refrigerator, Nick, $1,500 fucking bucks, and it's not one singing and dancing with LED displays and stuff, which I don't want anyway. Yeah, if somebody says, "Torsten, you're too fat, we lock you out of your fridge," and they can do that remotely, I don't want that. But the last fridge I bought when we moved into this house, and it was, I think, $500 or $600. Same fridge, yeah, same functionality. And you think, yeah, that's real inflation. And we have the data now. The good data is all lies and shambles. Everybody sees that, but the market so far is choosing to ignore it. And that's where we are at the moment.
Everything you said there is absolutely fair, and I can't argue with that at all. You know, as you rightly say, if you can't trust the employment numbers, then you probably can't trust the CPI numbers. And I think that's very true. And your fridge example is also very true. I mean, you know, I also spent the bad news about your 1,500 euro fridge is that it's 2-year guarantee, and in 2.5 years it will go, because our 1,500 fridge had a 2-year guarantee, and in 2.5 years, so last month, it went and needed repairing. So good luck with that one.
In Germany, you call it Hauswirtschaftsraum, where I do my ironing to channel my Zen-like instead of yoga stuff. I have a fridge in there which is 30 years old, still working. It's time itself. Yeah. From Bosch, with a freezer compartment and everything, this thing will work forever. Yeah, good quality, no built-in obsolescence, which they are seemingly do now everywhere. So you see, times have changed, and everything in this economy changed. We talked in the green room earlier about, give you this example. There is, I heard that in a very good podcast in Thoughtful Money. Stephanie Pompoy, one of the great analysts on economic data, she said she's also following a guy, you have to Google it up yourself, who is showing the inflation data from the pre-Clinton calculation area. And he said, actually, no, we didn't top out at 9.5% or 10% or something like that. We topped out at 18%. 18%, 2 years in a row. If you have 18% inflation 2 years in a row, you lose 40% of your purchasing power just in these 2 years. So we are royally screwed everywhere. And this is also one of the points why I'm so adamant about recession. We're already living in a recession. It's already there. In I don't know how much time in the future they will put in the gray bars over the time we have now, when it doesn't matter anymore. When doesn't it matter anymore? After the 5th of November. Then everybody can be honest again, right? When the election has happened in the United States, then we'll suddenly see the real data, and everybody said, oh shit, I could have sold my stuff at 6,000 in the S&P, and I didn't.
I mean, we can talk about the future and you know, about the economy and about stock markets. I think, again, the other side of the 18% inflation instead of 9% is that the corporate America has, or the world has actually made extra margin on this stuff. So it's not unsurprising that VP Harris is now looking to try and tone down what corporates can charge. And you and I both know that that's not going to work, and it's kind of a sort of not a sensible policy. But understand that the reason that the stock market is going gun-ho right now, and it's still forecast to go gun-ho for next year and the year after. So this year, growth, earnings per share growth 10%. Next year, 15%. Year after, 15%. Now, I've said this before, and somebody actually asked a question. I didn't understand the maths. They said, well, very simple. Earnings per share, multiply that by a forward PE ratio. If let's just say it's 20, it's 21 forward PE. So 20 times, at the moment, the S&P is sort of forecasted to make 315 next year. So 315 as a percentage, it's roughly 6,000. Yeah. So that's the earnings. Multiply 315 by 20, you're at 6,300. And then now look at it again for, the year after. They're not expected to make 315, they're expected to make 350. 350 times 21. Then suddenly you're at 7,000. This is how the numbers build up. And the problem comes with these numbers is when the recession really comes to the front of these analysts who basically say, actually, there's no way on earth that these companies are going to grow by 15% next year because of X, Y, or Z. Now, that may not happen until after the election, but until the election, the analysts driving investment from institutional money, and it's pushing the market up. But we saw with this whole Japanese thing, I'm going to call it, just how vulnerable this market really is at these levels. And it just means volatility. And for people like you and me, that's kind of good. But for people who are long-term investing, over the long term, they may not eke out the gains that they expect. In the short term, you're just going to get sort of this kind of zigzag over the next 10 years. And, I think it changes the nature of how people should be investing in stocks. And that means education. And that means, all of the tools that you and I actually sort of are showing.
That is actually, you mentioned volatility. It's because we discussed that on Monday in our virtual trading floor. We have already got the next trade lined up again. Yeah, the straddle I demonstrated on this channel a couple of times how it works when you're trying to take out a new all-time high. And volatility is usually very low in that. And it worked like a charm several times. Yeah, one of the coolest trades I actually know. Markets are trying to take out new all-time highs. The moment you are at the new all-time high, you spend a lot of money for buying a call and a put at the money. However, usually volatility is relatively low or extremely low. So you can buy this good stuff for very cheap money. And if the market is trying to take out the new all-time highs, I already said to our boys, yeah, sure, and girls, sure. If we have low volatility at these levels again, we just do the same again, which brought us money the last time. However, what I'm seeing at the moment is we're trying to creep up to the 6,000 level, but volatility is also trying to creep at the same time, right?
That's an interesting thing, isn't it? And that's exactly, when we have a look at the charts, it's really not clear that we are, where we are in terms of, are we going to break or we're not going to break? But the patterns are really interesting. And, we should sort of update everyone with some of these things.
Yeah, excellent. So you brought the charts with you. We wanted to look into the S&P, the NASDAQ, gold, and Bitcoin.
Okay. So let me firstly share, do the dangerous thing, share desktop. There we go. We have Bitcoin up here.
Yep.
So, all right, let's start with Bitcoin. Why not? I look back at a text from a very good friend of mine who always sort of asked me, what do you think of markets? What do you think of Bitcoin? And his text was May the 28th. And I basically said to him, leave Bitcoin alone until, and actually in the text I said until September probably. But I think a month later, you and I did a video where we talked about cycles, we talked about the Elliot Wave pattern, and we fine-tuned that date down to, I checked that video as well, it was August the 7th. So plus minus, actually August the 5th, as we know, was a significant low. And so you can see that on the chart here. what have we done? Okay, we're showing this thing from that very important low in September. It was an important low not just for Bitcoin, but also for Nasdaq and everything else. It's kind of moved from September 23. So we know that was a significant low. And if you remember the kind of discussion that I had with you the last time, I said, it could be this and it could be that, and look at the length of this wave and the length of that wave. There is a kind of a guideline in Elliot Wave, and it talks about having the right look. And the right look basically so implies some symmetry in the pattern. And so here we are. I'm going to sort of point you to 2023, the lower left thing. If you can see my cursor winging around here. We had a very sideways kind of price action, and that lasted a fairly long time, and that's in purple, the box. And then after that, so we formed a low, a key low, and then we still moved up somewhat, and that's the orange box. But after the orange box was finished, the market did rally, and substantially thereafter. And then we rallied right up until March of this year. What did we do from March this year? We attacked the highs. We were at 70,000, then we came down again to 50,000. Then we attacked the highs very close to 70,000, but we didn't break the high. And this was the whole time I was saying the cycle pattern, which is not something that I use for Elliot Wave, but it is something that I use to support the Elliot Wave, because cycles give you a much better timing assistance, whereas Elliot Wave gives you a kind of a price and pattern assistance. So I combine the two and it works very well for me. So I was saying at the time, I'd leave it alone until, as I said, first time September and then August, early August. And, you can see from this low here where I'm it's labeled blue Roman numeral 4 circle here, down here so top right, that low was around about 49,000 or something thereabouts, and that low was August the 5th. So timing wise, that was kind of perfect, a perfect call, if you like, and we announced it. And so now where are we? The size of the box looks proportional to the size of the box in the previous pattern, wave 2. This is a wave 4, so the length. The time of that is fairly equal. And now we're in the orange box zone. So what does that mean? If things are going to repeat the way they repeated before, so we found our low, and then we need to start to move up. So looks here that sometime around early September, we might, if we are going to push higher, then that thrust higher is likely to happen in the sort of early parts of September. And I showed the cycles before. I won't do it again because these were fairly fixed cycles, but broadly, the low in the cycle kind of coincided with the low that we saw here. So Bitcoin for me looks, it's looked since August, early August, very good. And it's sort of traded fairly sideways, but it is making progress. It's now 61,700, nothing to do with the Fed, by the way, at the moment. So just follow the patterns. We kind of forecast this already in May, June, long before the Fed were, sort of decided what they were going to do and what the markets were like. So the pattern does look like we'll sort of push higher. From here, the next wave don't have a sensible target. There are plenty of forecasts. I'm not going to sort of join the crew and say 500,000 and all of this stuff, but that there are, I'm looking for somewhere around 100,000. There are sort of, for Bitcoin to actually make progress and not just be sort of a speculative instrument. Firstly, we have to think about use cases and stuff like this. And it looks like, and we mentioned this before, that the US is considering, at least there'll be a paper that will go to Congress to suggest that the Americans should be buying 5% of the Bitcoin supply. They already own 1% of the Bitcoin supply through confiscations and all of this stuff. And that should be part of the reserves, similar to gold. They've got about 5% of the gold supply. So it will go towards the reserves in order to strengthen the dollar, which at the moment does need strengthening. I mean, BRICS are expanding and all sorts of stuff going on. So anything that they can do to raise the level of confidence in the dollar, I think would be a good thing. The bad news is, I think if Harris comes in and puts Gensler in as the Treasury Secretary, all bets are off, right? I mean, that will be a biggest disaster for Bitcoin. He's not a fan.
You sure he won't introduce price control in Bitcoin? Because as Mrs. Harris said, she's like our Mrs. Baerbock. She was talking about price gauging. Have you ever heard the word price gauging? Well, you hear it from my lovely accent. It's not, English is not my first language, but price gauging, really? You really know what you're talking about, woman. For God's sake, unbelievable. Now, let me give you a market scenario for if we see a breakout after your orange box in there. So when the market starts selling off, and you've noticed I use the word when, not if. When the market starts selling off, all liquid assets will get sold out, yeah, and gold, unfortunately, will at least be one of them. Yeah, when we see correlation going to one everywhere, in all asset classes, gold will sell off as well because the margin calls will come in.
Yes,
I think that probably will not happen to Bitcoin, because Bitcoin is not such a big player in this market. People have to liquidate when the margin calls come in, so that could be relatively stable. And when the markets then take a big dive or recession is here, then there could be actually a market case for Bitcoin to achieve these levels.
Yeah, I mean, it will be an interesting thing. The question is just how correlated this thing is in an environment where Bitcoin is still finding itself. Yeah, it's still finding itself in a place in the financial community, you know, initially with retail, and then with institutions, and now with potentially governments. You know, there's no reason for it to continuously follow NASDAQ. And that's why I think when it's sort of orienting itself into kind of a more institutional product, you can imagine it will have a life of its own. But I take the point, you know, we saw that with the Japan thing. When the markets came down, kind of everything came down because, you know, people were forced to sell. You know, they sold. I mean, that's just the way of it. Okay, well, that was a sort of a gentle intro to Bitcoin. Just one sort of move into yield. It's on the way, and I won't spend too much time on this one. It's the same view as before. You know, this is a kind of a long-term chart, but here we go, sort of bringing it down.
So you've got the 10 years on the screen now, right?
This is the 10-year yield. So this was the time that you and I, on the top left here, November 23, where you and I were saying to everybody, I think it was before we got to the high in yields, we were saying, ship it in, this is nonsense, you need to be buying the 10-year. You know, everyone was saying, sell it, it's going to 6% and so on and so forth. The trend guys were getting a bit carried away, and you and I were saying, no, don't do that. You know, it's a winner. Down yields went, so it proved the right thing, but they went down with a sort of I would say somewhat over excessive optimism in January of this year with the 6-7 rate cuts. Then, you know, we had great analysts like Jim Bianco saying, I forget that, there's not going to be any rate cuts this year. And the market was kind of then sort of caught up with the analyst view that you're right, higher for longer. And this pink zone was where I was saying to my institutional client, you know, here's where you really need to be buying this thing for a move down into this green zone. So that was when we reached the 470, 460, 470 level. Actually, sort of the advice was I prefer the 2 years rather than 10 years, but, you know, this is what the 10-year would do. And, you know, we are back now into the green zone. We just touched the green zone. And again, we've got this optimism. I don't know if it's over optimism this time, but anyway, we've got an optimism of yields going down towards sort of 200 basis points from where they are today. This is the sort of December, 3-month December contract. Here was my minimum target, 95.50, when we were sort of way down here. And on the December 25 contract, my target was 96.5. And what does that mean, 96.5? It meant I expected 3-month interest rates to move from where they are today, 525, 550, to 3.5% in December next year. Now, where are we today? We have exceeded that minimum target. We got to 97 as a price on this contract, which means that the market estimate is for interest rates, 3-month interest rates, December next year to be 3%. So that means that they really do believe interest rates are going to fall down from 5.5% to 3%. But I mean, my view is they fall because inflation is falling. But of course, the market is almost certainly such a drop in interest rates. You can probably imagine that there is a large element of that for recession fears. But when you and I look at the stock market and these earnings forecasts, there is zero recession being forecasted. So the two markets are not in sync. And I think it's important that people understand that I think that there is some other stuff that they need to consider. Yeah, I mean, the story is being told here, and the two don't match. So let's
well, it's a good indication. It's usually the bond boys are cleverer than the equity boys. You know? The market is 3 times the size of the equity market still, even though when everybody's just talking about equity markets. But it's simply the flows. Where do you put your so-called safe money? And that's what interest rates indicate. And I think they're sniffing that out a little bit earlier than the equity boys, who are completely blinded by FOMO at the moment again.
Yes, indeed, it is FOMO. And, I'm sorry to say that, you saw that today with news headlines which I read, and I do chuckle every time I see this stuff, is, Dow up 300 points as Fed signals September cut. You can imagine all of these traders say, oh, I didn't know that. Let's go and buy some stocks. Of course, rate cuts equals go and buy stocks. Don't understand anything. Anyway, so the market got rather excessively wild for a very short space of time. And, I don't know what to make of all of this news. But I think it's sort of certainly guiding people the wrong way. Anyway, let's go on to gold. Gold is gold. I mean, we've been singing the praises of gold as being the real risk-free asset for a while. I think I've got an arrow on this. Yep, that arrow was the end of our video, which nobody watched, right?
Yep.
Well, not very many people watched. And shame on you. We shamed them before. We'll shame them again. Where I said, you've got a very low, from an Elliot Wave perspective, you've got a very low risk return, low risk to return thing. If you went and bought this dip because your stop loss was something like $8 away. So $8 away, the gold price was trading there at 2292, and this low was 2284. So that was your risk. So gold is now 2,500. So that's 10% higher. So it's $300 higher. Your risk was $8. You decide how you want to sort of forecast these markets. But if you want to forecast them on a news report saying Fed signals rate cuts, then that's not the right way to trade the market, in my view. So anyway, we told people this was a buying level. And, I've got different, as always, what could this be? Is this just up and away? And, it could do. We know that central banks now are the big buyers of gold. It's not retail. Retail are probably more selling. Certainly a lot of German retail are selling their ETFs, their gold ETFs. They haven't seen prices 2,000 for 10 years. So what do you do when you see your price again? You sell it. So, certainly the German retail have been selling, but central banks saying, no, you want to have some of this stuff. And so the Chinese have been buying, and the Turkish have been buying, and the other central banks have been buying. the Chinese have kind of put their stuff on pause for 1 month. I don't know where they are, but again, it's the same philosophy as what the the Americans were thinking of doing with regards to Bitcoin. It's all about currencies, right? With debt, the way, debt is just exploding everywhere. It's not just in the States. It's not just in France. It's everywhere. So you need something to avoid people looking at your currency as just being worthless bits of paper. So shoring up your currency with assets that people trust is the most important thing in my view. And it's the thing that why I say this whole Japanese thing is not over, and why I brought up the examples in our last video where politicians are asking their pension funds to make clear where they're investing the money, with the intent to say you're not investing it enough in our country. The Brits have already started that, and I guarantee you this is a trend. So let's have a look at the chart. What do I think? So the first wave, we went up here, I call it wave 1, and then we had a correction down here, wave 2. Now the issue is then what happens next? And at the moment, this sort of zigzaggy type up move does open up various alternatives. For now, this thing is still up, and you play it that way. But there is a slightly more bearish slant to this particular phase of gold, where you could interpret. Remember, this is the famous arrow down here, where you could interpret this as something called an ending diagonal triangle, and an ending diagonal triangle basically would mean sort of this pattern here. So the wave 1 looks like an end, it's part of it. You could count this wave here as being part of an ending diagonal. One thing it has to do is to stop before this wave 5 being the same length or slightly longer than wave 3, and that is at 2658. So if we stop before 2658, it's likely that this ending diagonal will result in a correction down to about 2,250 or thereabouts, probably before the next move.
It's probably what I told you earlier, September,
possible,
when markets will sell off. Then we have correlation 1, and the margin calls will have to be fulfilled. And gold had a fantastic run. What are people selling when they need to make their margin calls? The stuff that has made money. And that could then be the correction in gold, which we also need to go to new super high in gold.
Indeed, and so on. And so the other thing about that's too Elliot Wave geeky. I'll leave that off. Let's move to stocks and NASDAQ. So let's begin with the NASDAQ futures. We show this because of the relationship with the yen. You can see the NASDAQ futures here in bluish, these candles, and the yen versus the dollar in red. And the video that you and I did in middle of July, at the top here, this little box here, when we showed this and said, it's all going down, mate, because, and we explained the whole Japanese thing, and everyone sort of took it as a carry trade only and got carried away with it. And in my view, got it wrong. Puns as well. So down we went. We'll talk about that low, one of your sort of specialties. And look what happened after that. So the yen stayed strong. Now, yen stayed strong. We can see that because the dollar yen is low. So the dollar yen was at 162 up here. It's now at 146. So a low dollar yen is strong yen and weak dollar. And if, people were saying, it's all over, isn't it? There's no carry trades over. We can now sort of do it again, mate. Go and sell the yen and go and buy some NASDAQs and NVIDIAs and whatever else that we do with our money. Well, that's not happening, is it? So you're not seeing any selling of the yen per se, because the yen has stayed strong. But what has moved, you know, sort of this correlation, if you like, moved against the Nasdaq just said, "Oh well, sorry, I'll just find another reason to go up," and off she goes. And this recovery is what we saw. And most people say, "Well, you know, what a V-shaped recovery," and you know, VIX down here at supposed 65, and actually reality 35, and the market rallies. But if you look at where we are, we're not making new highs, and you know, we're kind of in an in-between state, and so you know, we need help. We need help. So we look at the Elliot Wave for this. Let me sort of expand the screen a little bit. So this up here, sorry, up here was on the top left was the, you know, the magical high that we forecast, and then we had this sort of funny shaped thing on the way down. A lot of Elliott Wave guys will look at that and say, well, it looks like 3 waves to me. And I agree. My interpretation of this thing was 3 waves. And at the end of 3 waves, what happens is the market then will rally to at least or very close to the old high. But let's just say it's not 3 waves. So I'm opening the door here for a little bit of, you know, I haven't broken any rules. And I've said, well, can I count 5? And I can. I can count 5. I can actually sort of, without breaking any rules, I can count this as 5. What does that mean? What that would mean very simply is that this rally is just a correction, and this whole move down, and I think I show it better here, you know, this whole move down is still incomplete. Okay, so that is an option. It's not a forecast. It's just to say, I can't, at the moment where we stand, we haven't gone up enough in the Nasdaq for me to get so excited about new highs. And when you look at Apple, Apple looks okay. When you look at Meta, Meta looks okay. When you look at Amazon, you think, nah. When you look at Google, you think, nah, definitely not. So not everything in the, you know, Magnificent Seven is firing on all cylinders. And of course, perhaps everyone's very euphoric about sort of, you know, NVIDIA earnings, and, you know, they want to see the truth before they make decisions. And I just say we are in that in-between state. So if I just sort of now pull up the NASDAQ index to give us a little bit more of a bird's eye view on what's going on with the NASDAQ, I have the same problem. Remember, I tried to look for symmetry, you know, this big thing here in the middle. The best I can do at the moment is to marry it with this sort of thing over here, and this sort of purple box left, bottom left, but with this sort of recent move we've just done. And if we are going to rally, and that was just a 3-wave move, and it was all over, then, you know, we rally to where we are now, roughly. We go down a little bit, correct, and then we kind of have to finish 5 waves to that new high, wherever that will be, 21,000. And there are, you know, some Fibonacci targets here, somewhere between 20,500, 21,500 for the NASDAQ, if we were to see a new all-time high. Of course, the other patterns in NASDAQ, as I explained to you, if this was not the low, and as I say, we haven't done enough to confirm A or B, that we stall here and then we, you know, move down, you know, lower towards the 16,800, something like that, basically a new low. And that sort of is again showing you an alternative thing. We don't need to worry about that. But basically, conclusion is NASDAQ ain't done enough, I'm afraid, to add any confidence, at least, to where that market is.
So would that also mean that the dollar weakness versus the yen is actually capping the potential of the Nasdaq?
Well, we're going to talk about, I think we should talk about that, because it's a really serious thing for investors. And, you know, they really need to understand what's going on there, because I think, you know, as I said before, it's all about the currencies and nobody's looking at that. They're all sort of looking at their Meta and NVIDIA, and I've got to buy NASDAQ and S&P, and, you know, because I haven't got enough stocks, clearly. We'll see if that's the case, but I'll get on to the dollar. That's a good point. So here we are. The S&P looks to me as though, again, we haven't quite got a new all-time high. We have what's completed what looks like about 3 waves. If we do complete the next wave looks as though it might well be the last. If I were to target somewhere here, I'd say around 5.8 before we see the next correction. But this is a good traders market, and what that means is, running positions short until short time wise, not short, running positions for a short length of time until you can see a clear trend. And at the moment, I don't think, even though we have had a clear trend behind us, I'm not sure whether the trend upwards or downwards is a gimme. And that comes to sort of what you were talking about. Can we do a straddle? And at the moment, it's not really obvious because the volatility is a bit high now. So you can't even do that. So let's, did we say we'd do anything else? Well, let's talk about the dollar very quickly on the dollar. And the point I made in our last video about the dollar was most of our viewers are European based. Not everybody is dollar based. And, with the dollar weakening, clearly, I mean, whether you talk about Fed pivot, whether you think it's the BRICS, whether you think it's to do with, it's clear if the government are worried about shoring up the dollar, they must think that something is worth worrying about in the first place. And it's something actually we forecasted already 15 months ago when we first started all of this stuff. We said the dollar weakness is the thing. So can you see this chart?
Yes.
Actually, this
beautiful. I love my volatility cones.
We're going to show that. Should we show that now? Well, we're here. We might as well show it. So this is the NASDAQ. That arrow there was very roughly the time where you and I were making our video saying the yen thing is starting, sell, right? Sell NASDAQ, that is. And down it went. Then you and I were on a call, and then you saw the cones and said, oh, I know what to do here. What are the cones? We should just explain. So this green cone looking thing and this orange cone looking thing, things that sort of are within the tactical brief, that's your business, created these indicators. They measure the expected move based on the volatility existing in the options market at a certain point in time. And I picked that certain point in time as this particular low, 24th of June. Why was that? Because it was the last significant low before the last significant high. So I take my cone from that point. I use the implied volatility at that level, which I think was 15.7, not 100% sure, 15.7 for the NASDAQ. And what happened? The market held the top end of the expected move, and then the market crashed to the lower end of the expected move, 2 standard deviations. And what did we see from there? You said it live on stage, as it were, to your clients and students. You got to buy this market here, and you immediately, I think you were already pushing buttons at the time. So here we go. And we're in, as I say before, we're in kind of the still no man's land to decide the next direction. So now we look at the dollar. This is this chart I've been showing to my institutional client with the move down, by the way, for a long time, and really for a long time. It's looked like it was forming some kind of corrective move here. The dollar got to around 115. Then all hell was breaking loose in the stock market. Janet Yellen came in and sort of, decided she was going to sort of flood the market with liquidity and, sort of put out her TGA account and, put liquidity into the system, reduced her holdings in the TGA. Dollar fell. We got to this sort of level, stabilized here, and then we did a lot of nothing really. It traded in a tight range between 100 and 107 or 108, something like this. The pattern looks corrective when it's sort of in this choppy kind of thing, and the corrective pattern means, main trend from this first move, let's call it the Janet Yellen move, down to sort of red A. Then you get red B, and then you get sort of 1, 2, and then 3 down here, green. You can see where my cursor is. then 4, and then a 5. So where does that put the dollar? It puts the dollar down to 88 eventually, right? So 88. So we were at 10, whatever it was, 5.6 when when I said we're going to get down here at 88. That's a 20% drop or thereabouts. Now, whatever you think you're going to make on Nvidia, if you're a European-based investor, you better make 20%, because if you're going to make currency losses, think about how your dollar investments are going to be doing. And perhaps, throwing caution to the wind, if you like stocks, that perhaps US stocks might not be the best option if that were to happen. If the forecast is right, if this thing were to play out as planned. At the moment, it's heading that way. So at the moment, US dollar investments are making about, let's just say the last couple of months, they're still up 2%, 3% for an American investor. But for a European investor, they're down 1 or 2%. That's not good. So, this is something that is a very important factor. And of course, every currency has bad things. We all know there's a debt problem. We all know that you're going to have to finance the debt. We all know that probably the money is going to have to come from partly central bank, partly savings institutions in order to finance debts. When you do that, then do you not take the money away from stock market investments? That's a story for another day. But anyway, this is a potential path for the dollar. And what we haven't broken yet is this green low, what I call wave 1. And as we haven't broken that, it still opens the door to, this was the very first chart I showed to my clients. I said we're likely to be in the triangle. So I drew an A, B, C, D, E. We haven't done E. We're still at D. And if D sort of breaks B, then probably the move down is over. It wouldn't surprise me to see a small bounce here, and then we sort of reassess whether or not this is still a triangle or whether the chart I showed you earlier was likely to happen. But it has severe consequences, if that's correct, on Europe for European-based investors, and they really do need to think about perhaps hiding within the Eurozone, scary that may be, until the dollar kind of finds its foot again. That's just something to bear in mind. Anyway, so we covered Bitcoin, we did a little bit of gold, we did 10-year, we did NASDAQ, we looked at the yen, and we've done S&P, and now the dollar. And
I have a nice slide to finish that all off, Nick, because that was in my inbox during the week, and replace current share. You'll see that now in front of you, because you just mentioned, can you see it?
Yes, indeed.
You mentioned, or you just said, where's all the money coming from? Yeah? And it's one of the main topics we always have, liquidity. Yeah, nobody cares what the reality is as long as they have money to pump into the market. And you see 2 charts here. Now, that's very interesting. It's the all money market funds total net assets as surveyed by Bloomberg, 21st of August 24. That's the white line, and it shows 6.216 trillion. So one could argue and say, oh, well, yeah, fine. There's all this money on the sidelines, which could eventually go into the equity market. Awesome. 6 trillion, nothing to worry about. And then they put it into relation versus the market cap of the S&P 500. That's the blue line at the bottom. And then the whole picture looks completely different again. Yeah, we have already had the massive inflow of money on the sidelines, which is reflected in the market capitalization we see at the moment at these levels, with a looming recession, with a dollar giving flack to the market, as we can see it. So my scenario remains bearish at these levels. Yes. And my question to you, I know you're also working for your clients on the whole liquidity scenario all the time. What does your data tell us? Is there still liquidity in the market which could support it, or is that draining away, Nick?
Well, the true expert on liquidity is Michael Howell from Cross Border Capital, and he's got his own service and stuff like that. And the latest tweet I heard from him was liquidity is improving. But, when you read between the lines, it's not as satisfactory as one would like to see for where the market is today. And that's my interpretation of what he said. Go and check out his tweets. But my feeling is that, where's the liquidity coming from now? Yeah. So you don't have anyone doing the old yen carry stuff. You got most people playing the game, I'm forced by my government to actually sort of look after my own economy rather than sort of invest too much overseas. So where is the kind of support for all of this? And remember, these numbers, the liquidity requirement is ever increasing. It's not just like, the requirement is a bit lower. No, this is something you need to feed the monster. And this monster is getting bigger. And he's coming out there every now and then and he's saying, I need to be fed. Feed the monster. You tell me who's feeding the monster right now.
Oh, I'm telling you, according to VP Harris, when she starts the price gauging, honestly, then all the stocks which had a fantastic performance, the retailers, the defensive values, the Walmarts of this world, then suddenly will not make any money anymore because the price gauging, according to Mrs. Harris, will subdue their revenues and their earnings. So people will start selling the shit out of the defensive stuff, but they're not going to buy Nvidia or anything for it. So in my scenario, we have a serious case here. And the more and more I look at the fundamental data, and you mentioned it before, when I picked the bottom, do you know how much that hurts when you're actually a perma bear in the market and you think, we've seen a fucking correction here, I'm going to buy that now. So obviously I'm out again on the upside. I'm now feeding the beast again to the downside for exactly these reasons you just mentioned. Where is all this money coming from? I don't see it anywhere. It's not piled up on the sidelines. Who should rescue this market when the big funds won't sell? And what everybody seems to forget, what worked for the last 15 years with Delta One products, just put all your savings into an index fund and be happy. It works both ways.
Yeah, and I think that's right. But again, as part of the training, you and I both sort of train people and try and help, the thought process. Yeah. And for somebody who just wants to sell the market, I think, and institutional clients are also kind of guilty of this. They say, I think the market's going down. Let's go and buy some S&P puts. Let's go and sell some S&P futures and stuff like this. And this is where a different skill set is required. And for example, this week or last week I said, Google. If you're going to sell something, sell Google, because it ain't going up. And therefore, if I'm wrong with the market direction, the S&P is going to go up, but Google ain't going to go up. Well, Google went up a little bit, but the market went up much more. And I think you need to be really choosy about, especially when you're trying to pick tops, because picking tops is, as dangerous as picking bottoms sometimes. It's a very difficult thing to do. So rather try to find something where you've got some tailwind on your side to give you more chance to minimize your losses along the way. And I think that's the other kind of thing that I would leave the audience thinking about. How do we kind of go into that selection process? How do we choose what to use as a hedging instrument?
Maybe another insight. We discussed that on Monday with our students. There was one idea to say, okay, you run a portfolio, decent size, you have all your money in there. What could you do in a scenario like this? And we thought, why don't we do the following? Just as an idea, consideration, what can be done actually? You buy a tail insurance for the S&P or whatever your weapon of choice in the markets is. 20% below the current levels, right? And the calculation we had for the S&P on the screen was for the end of the year, they did cost you something like 38 basis points at this level, but it would protect you when the market really takes a big dive. Fine. At the same time, we could go to 6,000 in the S&P, no problem whatsoever. Yeah, you buy a tail hedge to the upside as well. So if the market overshoots on the upside, you'll get part of your not being investment in back. What do you do with all your money in the meantime? And then one of our students said, well, I simply put it in treasuries, in bills. gives me 5%. I have a portfolio which won't hurt me at all. Yeah, I get good treasury money in. I have a downside protection, which in this case will even generate profits for me. And at the same time, I'm spending a little bit for this tail hedge to the upside to say, fine, if the market completely overshoots and we run into 25 and have this scenario like in 99, 2000, where the market goes completely batshit crazy, well, you're part of the game as well, but you've eliminated big chunks of your risk in your portfolio, and I like that at the moment. I'm looking into that, how to set that up properly, because I think that would be an appropriate strategy to handle these markets where we are at the moment.
Yeah, I mean, we're at that stage though where volatility has probably ticked up a bit too much to kind of make it a real kind of no-brainer trade. But nevertheless, I think it is important. But
I hate to say it, well, not really. Obviously, I love to put in a couple of not so humble brags in here, but we said it with the volatility on this channel when everybody was talking about, oh, we've seen the volatility spike, correction is over. BS. It wasn't. It was only on the VIX through to the calculation methods. The future, who is representing actually the at-the-money volatility, wasn't spiking. Yes, it was higher than usual, but not panic levels or whatsoever. And what we're seeing now, we dipped under the 15 in the VIX, which at this time is not through all weird calculations. It's actually representing the at-the-money volatility relatively well. But we're ticking up. People are getting nervous, especially before weekends. You can see they're not going to sell volatility. It's too dodgy what's going on. And if I see a real run into new all-time highs, I want to see volatility falling, like we've seen in the past when we made then consequently more new highs after that. If this time it's different and we don't see falling volatility while creeping up to the 6,000 again, I think that could be a very, very good sign that we've now reached the end of the line, if that is the case.
Yeah, I mean, as I say, it's very difficult to kind of watch the markets when you know that, you know, some of the numbers that are the fundamental kind of pieces to your decision making, like the employment number, is going to be literally a million wrong. So, you know, I would just simply say that there is a very good service from, I think it's FactSet. Every week they do a summary of the earnings and earnings forecasts, you know, from all of the companies and stuff like this. You know, for me, that's an indicator to watch how analysts are moving their kind of estimates for the earnings over time, you know, based on what the CEOs are saying and all of this stuff. And I think that's probably one of the better sources of, before I get too bearish, you know, I think we'll see it. The CEOs will be telling us that actually it's really not easy out there.
Good. So let's finish with not what we think what it is, but what do we have in in our portfolios. I have in my portfolio, I'm still gold long. That was a trade we opened up. Well, you showed it. That was the second dip we bought in. So still being long. Gold, I think, is chance risk reward. It's great. Yeah. What can you lose? $500. How much can you make? $3,000, $4,000, $5,000. It's a good part of every portfolio. We bought the dip in the Nasdaq and the S&P. I'm already out again. I'm now playing it again from the more cautious short side, but I'm seriously looking into putting money into treasury bills again and have a tail hedge to the downside and a tail hedge to the upside and reduce risk in these markets till we actually see in volatility the second shoe to drop. It has to. Only then we can say, yeah, fine, we've seen a real correction, because what we saw was a head fake. And that's how I'm approaching the markets at the moment.
Gold, Bitcoin, already for a while. And from equities right now, I'm short Google versus China, and mainly Alibaba. So, and I had that sort of trade for a while. It's working quite well. I think, as I say, I think there's still a good story. You know, Alibaba has been ignored and forgotten for probably the right reasons over time. But the differential between the valuations, I'm sorry to say, you know, it's worth having that punt back into the some of these Chinese stocks, in my view.
That will please your Chinese overlords, which we are also available to hire in China for bar mitzvahs and parties and everything. So we will stick with. I'm with you on the Google trade. Yeah, I think yes. Especially again, I'm bringing my recession theme in again. How they're making money, advertisements. what's going to suck the big one?
GPT or something like this. People are using different search engines now,
Yep.
not the traditional one. And the moment that the corporate start to figure that out and say, well, actually, what do we need to spend money in that place for? And then they'll look for another way to get money. But this is a very difficult time, in my view, for Google. And they need to come out with, we're not losing money. We've got a solution. Don't worry about it.
Could be long-term the Yahoo moment. Or AOL. I had an email the other day from somebody who still had an AOL email address. How does that happen? I didn't even know that was still possible.
That's worth a lot.
Anyway, so I hope you enjoyed our little show. Nick, any final words?
I'm going on holiday.
You've earned it. Then thank you very much for being our guest today. I hope you will check in next week again. And let's see what exciting will happen in Jackson Hole. By the way, I Googled Jackson Hole earlier, Nick. I don't know whether you know that, why they met in Wyoming. Apparently, Paul Volcker, then head of or boss of the Federal Reserve, he liked fly fishing. And in Jackson Hole, there is perfect place to do fly fishing. So some things don't change, yeah? So we are going to do our offsite somewhere
near a golf course.
Yes, some with mountains and cold and lovely hot drinks, stuff like that. Anyway, thank you very much, Nick. Thank you very much for viewing us again, and hope to see you next week. Bye bye.
See you. Bye bye.